Morning to you all. Good. Well, anyway, I'm back. I have been following the markets whilst away. I was back Thursday evening. I didn't go to the Gold Cup. Give myself time to recover for the weekend. Um, Interesting moves in the markets. This is such an important week this week, so I'm going to hopefully skedaddle through what happened last week reasonably quickly because we've got to look at what's coming out this week, as you can see in this calendar. I'm sure you've glanced at it already. Rate decisions galore. I counted 5. Can't remember there being 5 before, but anyway, or 5 important ones, I should say. Yeah. Anyway, last week it was inflation data that really put paid to, I suppose, any lingering hope that the Fed would cut interest rates more than this 3 cuts that they had suggested in their last meeting. Anyway, equity markets now expect the Federal Reserve, or the Fed as we call them, to cut rates 3 times this year. So the markets have fallen in line with the Fed. If you remember at the start of the year, we were looking at this, the CME Fed Watch. It had rates being cut in March, in May. I think 7 rate cuts were being forecast at the beginning of the year, throughout the year. Well, I'm afraid that ain't happening anymore. And the first rate cut is expected to happen in June. Or even then, the probability of that happening has diminished a little bit last week. So what was it? It was stronger than expected inflation. If we look at the calendar from last week, do you remember we had that US CPI data out? I remember a green number is higher than expected. In this case, worse than expected. We don't like inflation, so a green number in that regard is not very good news. The headline CPI inflation data reported inflation stronger than the consensus, up 3.2% annually. There we go, 3.2% annually versus 3.1 expected. And you might think, well, 3.1, does that really matter? The fact is, it disturbs market expectations. It disturbs what the Fed will be thinking when they meet this week, and the probability of a rate cut in June. Anyway, the core CPI rate, which is the one that excludes those components that caused inflation in the first place 2 years ago, i.e. energy and food, that was also stronger than expected at plus 0.4%, was expected plus 0.3%. And the annual rate, although it doesn't show it on here for core, that dipped to 3.8% from 3.9%. And it was a bit weird, really, because I didn't actually follow the markets that day. I was definitely racing at that time. But when I looked at how the market had reacted, actually last Tuesday, the market actually had quite a positive. So that's just Monday, Friday, Thursday, Wednesday, Tuesday. So this day, Tuesday, markets actually did quite well. So it didn't. So the poor inflation data didn't trigger much of a reaction in stocks at all that day, because I've looked at all the other indices and they all closed up on the day. But it was the producer price index. This, we don't often, well, I talk about it because I quite like looking at the PPI. It's a great sort of leading indicator for future inflation. So PPI stands for producer price index, and that really is the cost of goods and services. I remember most developed economies are more service-based than manufacturing, but it's the cost of those goods or services going into production, so at the factory gate. And here we can see, plus it was a lot higher than expected, and doesn't normally create much of a reaction in the markets, actually, because it tends not to be looked at that closely. But markets are very sensitive, especially when you get CPI up more than or jumping rather than staying unchanged. We looked at this very closely, or the market looked at it very closely, plus 0.6%. And anyway, with the Federal Reserve's inflation target at 2%, this PPI release suggests that hitting this target is going to remain some way off, albeit with a degree of uncertainty, of course, as well. So that's what caused the markets to fall last week. I say fall. The FTSE and the DAX actually had a good week, but the NASDAQ was down over 1%. The S&P, actually, the S&P was unchanged when you look at it here. That's the 8th. Yeah, it's pretty much virtually unchanged. The Dow Jones also unchanged as well when you look at it on this chart here. The 8th to the, yeah, pretty much unchanged. Yeah. European markets, very quickly, DAX, better shape. Yeah, UK and German markets registering good gains. The DAX was up just shy of 2%, 1.8%. And even our lowly old FTSE, which has been a serial underperformer, up 1.4%. And I guess UK markets, a bit like their US counterparts, will be dealing with these central bank decisions this week. Not only have we got the Bank of England, we got the US Federal Reserve, we got the Swiss National Bank. They're all over the place. There's a lot of key announcements, albeit we're not expecting any change in rates. But anyway, we'll be dealing with our Bank of England, our Monetary Policy Committee, like the US markets, will be dealing with the Federal Reserve and the FOMC. And I think forward swap markets here in the UK imply a lower probability of a rate cut anytime soon. I did always wonder when these markets just got so ahead of themselves. And I'm one that quite likes higher interest rates. My daughters don't. They're borrowers. I'm a depositor, so I'm quite like higher rates. And I was sort of wondering whether to fix a higher rate with a view for rates coming off in the next sort of 3 months. But the market seems to think August is the first likelihood of a cut in rates. And it's weird, actually, because you look at the Bank of England's inflation target of 2%, and a lot of analysts believe this is going to be hit in the next few months. But the forward swap rates imply that the first rate cut won't be until August, with another, maybe one, possibly two, I should say, definitely another one. So at least 2, possibly 3 rate cuts before the end of the year here in the UK. The reason why I don't think they're going to go nuts is that pay growth is still a concern for the bank. Do you remember we always had this criticism that inflation was a lot higher than pay? Well, pay growth is a lot higher than inflation now, and that's something that the Fed will have to consider. US dollar, well, we can look at the euro. We could actually look at the US dollar index here. Yeah, better week for the dollar. Recovered some lost ground last week as those forward rate expectations that we've just been talking about dimmed. I also note that a recent survey of academic economists reported that the first rate cut should be in September this year. So those are people who look at all the numbers and thinks, right, it can't happen until September. And this is opposed to a June rate cut that the market expects. And I think the reason why the markets are pretty convinced it's going to be June is because of political considerations. September would likely be too near the presidential election in November. Mind you, I think President Biden would much prefer a rate cut as soon as possible, of course, but I guess he's not really responsible for controlling inflation. Anyway, so yeah, pick up in the dollar. Pick up in the dollar also affected gold, I should say. So gold off 21 bucks. Yes, last week, strengthening US dollar, a dollar-based commodity. When the dollar strengthens, it's negative for any dollar-based priced commodities. The gold's moves over the last 2 weeks have really confused analysts. I tried to sort of think, well, what are the main reason? And China buying, speculative interest as well. Obviously, with the dollar, that explains why, with the dollar weakening, I should say, over the last sort of 4 weeks, not last week, but over the last 4 weeks, have contributed to the bull market. But the hawkish move in interest rates, when we've looked at those forward interest rate swaps implying fewer rate cuts this year, that would be a drag on gold, because the cost of financing gold, interest rates are a big opportunity cost to gold holders. So if you hold gold, you've got to forego the return you would have got by placing that money on deposit. So higher rates tend to have a big drag on gold. You wouldn't think so looking at that chart, would you? Not really. Anyway, it's speculative interest. Yeah, well, also, I'm reminded by who's Peter about the record highs in Bitcoin. That may be one of the causes that gold's had this record-breaking run. Yeah. Oil, very quickly, oil continues to rally, up 4% last week. Big move last week. Yeah, over $3, which is about 4%, isn't it? No sign of any ceasefire in the Middle East between Israel and Hamas, and I'm not sure that that's necessarily the reason, but that's not helping. And I think the IEA, that's the International Energy Agency, came out and changed its forecast on supply and demand for oil. In its last report in January, it predicted a surplus in oil, but that was back in January. But it now expects demand to outstrip supply, only modestly, very modestly, but leading to a small deficit. And I think that may be one of the reasons why we've seen oil lift from this relatively tight trading range that it got stuck in between sort of 80 and 83 bucks. Anyway, onto the calendar. Let's go. Big week this week for interest rate decisions. We've already had some data out from China, industrial production and retail sales. Stronger than expected industrial production. That'll cheer up Beijing a little bit. But the main event Tuesday, or one of the main events Tuesday, the first central bank policy meeting from the Bank of Japan, or the BOJ as it's called, is set to raise its key interest rates for the first time. It looks like it's not raising them, according to this, but the forecast, the expectation is it's going to increase them to a band of 0% to plus 0.1%. And I think that forecast there from Forex Factory is not correct. Japan this morning will be considering reversing negative interest rates for the first time in 17 years. Wow. Well, Michael, that's pretty much what we're expecting. Yeah, that's right. The first time in 17 years. It's gosh, it's been a long old road, hasn't it? But I think it's had been discussed. It was supposed to happen the previous month, actually. And it's also, I think, expected to end its yield curve control measures. This is where it was keeping the 10-year yield, the yield on the 10-year JGB, the Japanese government bond, below 1%. I think it will try and smooth out any sort of significant moves on Tuesday if it does do this, but let's just say that the Japanese yen is going to be really sensitive to this too. So any yen crosses, you know what I mean by yen crosses, so sterling yen, dollar yen, euro yen, New Zealand yen, Aussie yen, all of those crosses, be very careful. It could be very volatile, and you can see how volatile it's been over the last sort of couple of weeks, falling from 150 down to 146.5, then back up again to 149. And okay, it'll happen when you're asleep tomorrow morning, unless you get up early, but it'll be choppy. So just take care of that, please. Okay. So after that, we have got in Australia, the Reserve Bank of Australia's rate decision on Tuesday as well. No change expected there in the rate, 4.35%. China starting to increase its purchases of raw materials, which always helps Australia. I was looking at a program on BBC, Simon Reeve, I think it was, with these huge, great coal transporters negotiating their way through the Barrier Reef. I just thought, gosh, that's quite a contrast, isn't it? Hundreds of thousands of tons of coal going through a very fragile environment like that. You think there'd be another way to go, wouldn't you? Anyway, so that's the RBA. That stands for the Reserve Bank of Australia, by the way, RBA. So no change expected there. And then we go to, oh yeah, by the way, it's a bit weird really. Tuesday actually is a bank holiday in Japan, and yet you've got the Bank of Japan with their policy announcement on Tuesday morning. I assume that the Bank of Japan's open. Anyway, the yen very, very sensitive to it, so please make sure you take precautions if need be. Wednesday, another central bank. Now, it's a bit weird. It's not like regular central banks. The People's Bank of China, or PBOC, makes announcements about its 1- and 5-year loan rates, and it sort of tends to surprise the markets with these announcements, but we're not expecting any change in the 1- and 5-year loan rates on Wednesday early morning. And then we got our inflation data. Yeah, just to add to a bit of grist to the mill, we've got our rate decision on Thursday here in the UK, but before that, we've got inflation being announced. So headline inflation expected at 3.5% annualized. That's what we're looking at on the screen here, which is a rise of plus 0.6% month on month. The core CPI rate, which is not listed here for some reason, is expected at 4.6%, and that's quite a fall from 5.1% last month. Yeah. So obviously this is going to really affect what the MPC announced the following day. So sterling and UK assets will be really sensitive to this release before the MPC. So 7 o'clock Wednesday morning. But of course the markets won't be open, or not the stock markets. They won't, but we'll see. And then in the evening, we have probably the most important announcement of the week, which is the meeting of the Federal Reserve's Rate Setting Committee, the Federal Open Market Committee, or FOMC for short. It'll be making its announcement on interest rates, which is expected to be unchanged. They won't be changing interest rates, and also any policy update with their dot plot, what the Fed committee members are thinking about where rates are going to go over the next 2 years. Anything that gives us a clue about when the first rate cut will happen will be seized on by the markets. There is a press conference to follow. Of course, yes, it's the hour. We've got the hour change still. That's a very good point. So we've still got just 4 hours difference, because it's normally at 7:30. Okay, that was confusing me. Press conference is half an hour after the announcement. That could be quite lively. Obviously, US dollar, US assets, and global assets for that matter will be sensitive to this release. So there's another one. Make sure you put that in your calendar at 6 p.m. Remember, it's an hour earlier because of the change in daylight savings in the US. That will all change again when we put our clocks forward at the end of the month. And then we have another monetary policy meeting, the Swiss National Bank, SNB. I won't dwell on that for too long. It's a policy update. No change in rates is expected there. We then have all this flash manufacturing and services PMI. You might just start to wonder what all these mnemonics and letters mean. Purchasing Managers Index is what PMI stands for. They're surveyed by S&P Global, used to be called Market, and this is the first of 2 releases. That's why it's called the prelim reading. And an economy, any economy is split into 2 sectors, the service sector and the manufacturing sector. And this is key data. We're looking for a pickup in both sectors in the EU, with both sectors slipping in the US. At least that's what's expected. And if you can see flash manufacturing and services, so both expected to fall from the previous month's readings, whereas the EU, or the Eurozone, we're expecting an uptick in both manufacturing and services. But you'll note these are still way below where the US readings are, which just tells you the story, doesn't it? A lot better economic performance in the US. Okay, Bank of England, MPC. So this is the final and most important central bank policy meeting for us here in the UK. The rate setting committee, called the Monetary Policy Committee, meets to decide on interest rates. They are expected to say no change. We will be sensitive to the voting patterns, and that's what we'll find out after the event. How many voted for or against? That affects the way the market could react. If there's if there's more people voting for a cut, it's possible that that could then push expectations forward from August. But anyway, the bank is going to hold rates unchanged this time around at 5.25%, and that is the 5th time that they've done that. More than 5 months though, because they don't meet every month. We call it their monthly meeting, but they don't meet every month. Anyway, sterling and UK assets will be very sensitive to this. So there's another meeting for you to just be, or release to be very, very careful with. I mean, any change to the view that the first rate cut, likely in August, if that does change, that will really affect sterling. So if interest rates are likely to be cut sooner than August, sterling will rally. And if there's anything that suggests that sterling will fall, I should say, sterling will fall. And anything that suggests that the rate's going to be maintained for even longer, and the first rate cut will happen, in Q4, then sterling would rally significantly, I suspect. And then on to Friday, there's so much data, I just can't go through it all, I'm afraid. But UK retail sales, core retail sales expected at -0.5% here in the UK, the headline at -0.3. Yeah, just a correction to last month's number, which is better than expected, really. Yeah, what a lot of data. I can catch my breath now. We did start later, as you all know, at 8:30. It is already 9:30. I do know a lot of you have got commitments and stuff, so I will end it there. It is a late one. I hope it's covered off everything that you needed to hear about. It is an important week. It's probably the most important week of data releases this year. It's just a coincidence that it's all happening in 1 week. So there we go. Any questions? Anyone want to know, apart from where I think the markets are going, which I change them all the time. I change my views all the time anyway. And I'll catch up again. I think we're on for another one next. No, it's not Easter yet. No, that's the end of the month, isn't it? Yeah. Okay. Have a good rest of the week, and we'll catch up again next Monday. All the best. Bye for now.